Hey everyone! Today we're talking about margin calls. The two words no trader ever wants to hear. Think of a margin call like someone tapping you on the shoulder and saying, "Hey, you've got a problem." Let's break it down. So what exactly is a margin call? Imagine you're trading with margin, using borrowed funds, and the market suddenly moves against you. Your account's value drops, and your collateral or margin isn't enough to cover the losses. That's when a margin call appears, which is essentially a polite way of saying, put more money in or we're shutting this down. Here's how it works. When you open a margin trade, you're required to maintain a certain amount of equity in your account. This is called the maintenance margin. If your equity falls below this threshold, the margin call kicks in. It's like someone saying, top it up or we'll liquidate your position. Now if you don't act quickly, things can get rough. When the margin call is ignored, your positions might get closed automatically to prevent further losses. This is called liquidation, or as traders like to call it, the walk of shame. But hey, it's not all doom and gloom. A margin call is more of a warning than a punishment. It's your chance to add funds to your account or adjust your positions to stay in the game. Think of it like a second chance, if you're quick enough to take it. How can you avoid margin calls? Well, for starters, don't go all in with leverage. Use risk management tools like stop-loss orders, and always keep an eye on your account balance. Platforms like CEX.IO offer features to help you monitor your margin levels so you can act before things get dicey. So to sum it up, a margin call is a way of saying, fix this or we will. It's not fun, but it's not the end of the world either. Just trade responsibly, keep your margin healthy, and stay ahead of the market. Thanks for watching, and remember, the best way to handle a margin call is to avoid it altogether.